Hi, I'm Robin Forster with FeelSoAlive, and thank you for joining us, either live or on the replay. And occasionally I'll be looking down, so just to let you know, it's because I'm referring to my notes and/or I'm making more notes, because we have a pretty exceptional speaker, and I have a lot to learn in this category. So, my intention for doing this is to share interesting and helpful information and to help you on your health journey, whether it's financial or emotional or physical. So, don't forget to like our Facebook page. And if you want to see more, check our YouTube channel where you will see this. We are posting twice a month. So, it is my great pleasure to introduce Barbara Evarts from Houck, Evarts and Company, and she is a CPA, and she is one of those people who actually know what the law is because she has read the law. So, Barbara, what we would like to hear from you, and welcome.
Thank you.
We are glad that you're here. And our first question to you is if you can tell us a little bit about yourself and then tell us how you got drawn into this line of work. Because being a numbers geek in the CPA world, that's very different than other things in the world to be. So tell us about you and how you got here.
Well, I kind of think that part of my uh, aptitude for this profession is an apple doesn't fall very far from a tree. My mother was a bookkeeper when I was a kid, and there were actually one of my early jobs as a teenager was working at the place that she was working at, and sometimes I would help her get some of her bookkeeping stuff together. So that was kind of fun for me. Uh, and in my early adult life, I did get a job as a bookkeeper and did a training course and landed a job and worked for a startup company that is long since gone, long since, it did not survive after a certain point. But what I learned there was vitally important in terms of how accounting works, how companies rely on financial information, and actually seeing the system that was put in place by the then controller who came on board from a what was, and I'm dating myself a little bit, big eight accounting firm. And that kind of gives people idea what that era was. To be able to see how we were putting together the what would be called a chart of accounts, how to categorize the transactions and the activity in the business to provide financial statements and how those worked. And I also had the, uh, I would say, unique experience, because not too many people these days can say this, because they're getting old enough to retire, or they're young enough that they don't remember a company ever having manual books. But we went from a manual accounting system to the first, what we would call mini computer, that actually was bigger than the suitcase that I take on vacation at the time. Now that mini computer would have a fraction of the computing power of the laptop that I'm using for this meeting today. So it was really quite interesting. It was an exciting time and for me. And at that time too, I was in my early to mid 20s, and getting, where you're just kind of getting your act together, kind of change of life, finally getting your act together and getting into a grown-up life. And had some people I was close to really suggest I should go to college. And of course, accounting in college and seeing what this controller was doing was very exciting to me. And so that was it. Decided to get an accounting degree, and I was going to go into industry, and I was going to, be the, kind of accountant that helps companies in that respect of being their internal accounting resource. And as I was going through college, that was my whole goal. And then coming down to about my last year of school, I took a career planning course as an elective. I needed a class, and while I was finishing up all my required courses, and really got introduced to the public accounting and what a CPA credential brings to the table in terms of professionalism, what you learn. And in fact, it's like I heard it this way, that it's like a master's degree that somebody pays you to get. So at that time, you had to have a 4-year degree. I'm dating myself again because these requirements have changed. And if you had a 4-year degree and you passed the CPA exam, you had to do a 2-year internship at a public accounting firm. So for me, I entered public accounting with the intent that I was going to get my CPA and I was going to go off into the wild blue yonder of other horizons. Well, as I started working, I found that I really enjoyed public accounting, and believe it or not, I really enjoyed taxes. And my career planning meeting at the firm I was working for at the time went like this. One of the partners was looking at me. He was like the tax director, and he said, so when you're going to decide to go either accounting and auditing, or you're going to go tax, you're going to go tax, right? Because it was obvious that that was what I excelled at. It's what I really enjoyed doing. And it was him reading the writing that was already on the wall that I had already read. So almost a little over 30 years later, here I am, still in public accounting, still focusing primarily in taxation, but a lot of areas of consulting with my clients, and enjoying it and having a great time. So what could be better? There we go. That's kind of it in a nutshell.
That's fabulous. I had no idea, but I have a question. So public accounting, how is that different from whatever other kind of accounting there is? And I don't mean to go down a rabbit hole on this, but is there something besides public accounting?
Well, there are people who do basic like contracting, bookkeeping services. There are places that can do tax work. You don't have to be a CPA to do tax work. What you must be a CPA for is if you're doing financial statements that are attest services. So you hear about these large public companies that have to have audited financial statements that are part of their SEC filings. And this is probably the easiest one that people are most familiar with, is that those services can only be done by certified public accountants. And other than audited financial statements, there is a classification of reviewed statements or even compiling financial statements. And those services are what we call the sole franchise of the CPA. It's the one place in our profession that other people can't do what we do. They must have the CPA credential in order to provide those services and hold themselves out publicly as providing those services.
Okay.
And along that line, CPAs have a much higher level of education just to be able to have the privilege of sitting for a very long 4-part CPA exam. They allow you to take separate parts these days, but when I sat, I had to take all 4 parts at the same time. It was 2.5 days, 19 hours worth of testing, and the first time pass rate was about 10%.
Oh.
Yeah, but I passed all 4 parts my first time. It was a personal goal that I did not want to spend. That's one of those you just want to sit once, right?
I have heard so many awful stories about taking those tests, but we're not going to go down that rabbit hole right now, as fun as it would be, because I know you have a ton of information and that you actually do, like you were saying, like taxes, probably love that whole world, and that you actually read what the law is, which I find fascinating because I've found that administrative rules just put me right to sleep. It's guaranteed. So, what are some things, thinking about the folks who are going to see this on the replay and they're small to medium businesses, or maybe they're thinking about starting a home-based business because the economy is a little sucky right now? What are some tips, suggestions, advice? How can you be supportive of folks? And I know you don't know them, so you don't know the particulars, but what are some things that you can share with us to help us not be quite so scared about the whole tax money thing?
Well, the first thing that, comes to mind is that, we had this this huge piece of legislation that came out right at the end of March. And for CPAs, I think the timing couldn't be any worse, in terms of being able to have to switch focus from the compliance that we were doing for 2019 tax returns and having to drop everything and pay attention to this piece of legislation, because that's what our clients needed from us. You know, the first wave was really looking at the pay check protection program loans and helping clients assemble their information so they could apply for those. There is a lot to unpack with that provision. As we know, the first loan program went very quickly, and it ran out of funds in about 14 days. Then there's round 2, which a lot of those applications are still being processed. There is some murmurings out there that it's not going to be enough and that they may be doing a 3rd round. So if you have a small business where you've had payroll and you can qualify for these loans, my biggest piece of advice would be, don't lose heart, keep applying and keep trying to, you know, just keep your hat in the ring, because if you go away, you'll get nothing. If you stay in it, there may be a 3rd round, even if you don't get anything on a 2nd round. Several of my clients have actually realized these loans, and then the next question is, how do we use these funds for the maximum amount of loan forgiveness that we can qualify for? So the main goal of the loan program was to keep people employed and to help small businesses manage their payroll, to be able to keep and retain their employees. So 75% of the loan amount, if it's used for payroll, you can have more that is used for paying rent, utilities, that will also be forgiven as long as you have that 75% is used for payroll. And payroll would be gross payroll to your employees. You can pay the health insurance. There's some other parts of that, like sick leave and things that can also be paid with that would qualify for the loan forgiveness. Right now, the big controversy is IRS put out a notice that the loan forgiveness would mean that you can't deduct the payroll costs of what you paid or the expenses of what you paid. There's been a very large pushback, not only from the American Institute of CPAs, that I feel they're advocating for my clients, as well as Congress as well. There's a lot of people that are pushing back on that, saying that was not the intent of the act. It's not a benefit to small business to give them this loan forgiveness and then take away their deductions. That's just taxing the benefit in a backdoor sort of way. Where IRS is coming from is not an unreasonable position, in that typically you don't get to deduct the costs of generating tax exempt income, because you get a double dip in that I don't have to pay tax on the income and then I get a deduction. Well, this is a little different. If I'm paying payroll, if I'm paying the rent that I owe, well, someone's picking that up as taxable income, either my employees or the landlord that I'm paying my office rent to. They're taking that money into income. So it isn't the same double dip. It's an entirely different deal. So those are some of the things that we're unsure about how that is actually going to be applied when we get around to the tax implications of the loan forgiveness. Some of that is still up in the air. And but there are professionals out there that are working very hard advocating on the behalf of business owners to have the most favorable result in terms of that. So wow. That I would really, and the other thing I would also say to small business owners, if they do have retirement plans, now these would be essentially 401k plans, that if there has been typically if you have a 401k plan, you can have a loan provision where your employees can borrow some of their vested benefit back. So they've increased that from a cap of 50,000 to a cap of 100,000. And they can, in that cap is related to the vested balance you have. Where they really modified the cap that can be helpful for people would be that they've lifted the 50% of the vested balance to be 100% of the vested balance. So if I was getting behind on my mortgage payments, or I needed a chunk of money, that one of the first things we start looking at is our retirement plans. What do we have? There's money in there, there's cash in there. If employers they may need to amend their plan document, and they have time to do that until January 2022, to allow their employees to be able to make these loans, and there is a more favorable payback period on it. And then employees, when they're paying it back, they're paying interest back, but they're paying interest back to themselves when they're borrowing from their retirement plan, which is better than a distribution, because you have an ability to pay it back. There's a 1-year moratorium that can be allowed on that repayment. And then you have 5 years on top of that. So you have like a 6-year period that you can borrow this money back at a very low rate of interest and pay yourself back. It's like borrowing your own resources and paying yourself back. That's one thing employers can do for their employees.
Wow.
Yeah, it's really kind of amazing, and it doesn't cost a lot to amend a plan document for this kind of provision. And if you have administrators that you're using, like my firm, our plan, we have a third-party administrator that when we say we want to amend the plan for this, they update our documents. Sure, it's a small charge. I mean, it may be a couple $100, but to be able to provide the benefit to our employees is certainly worth it, because it's a way that we're going to help support them and help them get through this time. Small businesses, you know how it is. We love our employees. We think about them like family. We want them to survive. We want to keep their jobs going. We need them. When this economy heats up again, and it will, every small business is going to need to try to get their employees back. And you don't always get your employees back. If they can't survive too long, they will move on to other things. So that's part of the reality of the situation when we have these what are considered temporary pauses that kind of go on a little too long. People need to survive. And again, along the lines of options that the general people might have, if you don't have the benefit of a 401k plan, you might have a simple plan at your employer, or you just simply might have an IRA. That there is the ability, if you've been affected by the coronavirus, and it is really pretty general about what they say, where they're basically saying if you've had your hours cut, if your business has been paused, if you've had to shut your doors, if you've had a decrease in business, the criteria is pretty broad for asserting you've been affected by the coronavirus, that people can withdraw up to $100,000 out of their retirement plans as a hardship distribution or their IRAs, and have the ability to put that money back in within a 3-year period. If they can't put the money back in, there's the law says you can take that and you can stretch paying that out over 3 years. So you don't, if I had to take, let's just say I had to take $21,000 out, because I got to make the math easy, Robin. Yeah, math in my head here. Let's just say I just needed the money to be able to survive a certain period of time. So I grabbed $21,000 out of my account. And what I can do is I can either let that whole $21,000 be taxed in 2020, because I'm going to have an election. I'm going to have an option to choose what I want to do. Or I can choose to let it be taxed at $7,000 a year in 2020, 2021, and 2022.
Okay.
And I have clear up until the 3-year mark to put the whole $21,000 back in. How that's going to work, if I choose, and let's just say things work really well and I'm able to restore it all in year 3, it's going to be interesting to see how we deal with year 1 and 2 when I already paid tax on that money. Do I go back and amend those returns and get my money back? Or do I take a big deduction in 2022? The law is a little unclear about how they're going to handle that. Right now, they're just saying the default rule is you get to spread it out over 3 years. If you don't want to spread it out over 3 years, you can have it all taxed in 2020. And you still have, even if you do have it all taxed, you still have that 3-year period to put the money back in.
Wow, Barbara, I'm trying to kind of get my head around all this information. And
It's a lot. It is a lot.
it is a lot, and that's one of the things I appreciate about you is that you understand this and you can explain, like you just did, the different parts of it and different pieces depending on your point of view. And I wanted to thank you for being so gracious, because I'm looking at the clock and I've used more of your time than we had originally talked about.
And we're kind of scratching the surface on some of this.
Well, that's what concerns me. There is so much more that we could share, but we can't because, time constraints. And again, I appreciate your schedule and you making room for us.
One thing I would add to what I just said, though, too, is that it's important for people to know that these distributions, if they take them out of their retirement plans, are not subject to the 10% early distribution penalty. That is an important thing for them to know.
Okay, and for those people who are thinking about that, that's good for them to know. For the rest of us, we'll just kind of let that go by if it's not an issue for us. But I appreciate your level of responsibility in making sure that that information got out so people know.
Yeah, it's an important piece.
Yeah, Barbara, thank you so very much for your time, and thank you.
Well, thank you for having me and letting me share. This was a lot of fun.
Oh, good.